of Bangalore branch of SIRC of ICI, I welcome you all to this study circle week on update on latest GST Advance Rulings. To share the views on this, we have with us distinguished speaker CA Kalyan Kumar. Now I request Jairam to escort our speaker CA Kalyan Kumar onto the dais and welcome him with flower bouquet. I take this opportunity to introduce today's speaker. CA Kalyan Kumar is a BCom graduate from Kuwait University and is a member of ICI. He has passed CA and CS finals in 2007 and 2009. He is currently pursuing LLB. Kalyan has over 13 years of Big Four consulting experience in indirect tax post his articleship training and continues to be associated with Big Four in Bangalore. He is currently working as Associate Director in DSR and Company LLP Chartered Accountants. He is specialized into indirect taxes covering sectors like IT sector, e-commerce, manufacturing, retail, etc. to name a few. Kalyan has been active and regular speaker in internal training and a speaker of Bangalore branch of ICI. With this brief introduction, over to you, sir.
So today's topic for discussion or deliberation is an update on the latest GST Advance Rulings. As you would be aware, the goods and service tax has been introduced from 1st July 2017, subsuming almost 19 indirect tax legislations. We now have one central tax, which is GST, covering the levy with respect to goods as well as services. Given the new law, which is hardly or less than 2 years old, there is bound to be what I would call as some kind of issue with respect to unfolding the law or evaluating the law to see whether the law actually caters to the requirements of your business or the transactions that you carry out. One of the facilities that's been prescribed or provided under the law is the facility to file an application before the Advance Ruling Authority. It's an application where you could ask some questions with respect to certain specific points that have been prescribed, only limited to that, unlike the earlier law where you could ask any questions. However, under GST is very limited to specific questions. Questions like applicability of registrations, classification, rate of tax, valuation, place of time of supply, etc. I will not get into the details of the procedure aspect of filing an advance ruling application. At the same time, I will briefly touch upon how an advance ruling application can be filed, very limited to an overview of it. So applicant has been defined to be a person who is already registered under the law, or anyone who is contemplating to be registered. So in effect, anyone who is not registered under the law also is eligible to make an application. As I said, the application can be made with respect to 7 questions or 7 pointers that I would call, which has been specifically mentioned in the application. Application has to be filed before the Advance Ruling Authority. Clearly bring out the question, what are the reasoning behind asking this question, and what is your view. You can put forth your view to say that this is the reason basis which I want an opinion or an answer from your end. So once the application has been submitted, the authorities would call for records to check whether your application can be accepted. If they were to reject the application, they will give an opportunity of being heard before rejecting. Otherwise, once they accept it, they will call both the assessee or the applicant and the assessing officer to hear both of them. So once they hear, they will pass an order. There is a time limit of 90 days that has been prescribed under the law to pass an order. The quorum of Advance Ruling Authority is 2 members. One is a CGST officer and the other one is a state's officer. Before we get into the specific cases, what are the myths that are surrounding around advance ruling as of now, or what we have carried from the previous regimes? One of the primary things that we keep hearing from businesses or clients is that many of the advance rulings that have come out, more than 400 advance rulings have come out all over India now, they are more of pro-revenue or pro-department. So that's the myth that is generally understood across the businesses, saying that most of the advance rulings are pro-department or pro-revenue and not in favor of the assessee. Whilst some of them could be true, but unless we deep dive into understand the facts of the case and the reasoning and the way it has been presented before the authorities, it may not be right to just generalize to say that all are pro-department and not pro-assessee. We've also seen, and as most of you are aware, given that it's a state-specific registration, if you have a question with respect to your operations or transactions, you need to file before the authority within the state where you are operating. So that gives to or leads to a situation where if you are operating in say 25 states all over India, and if you are carrying out a similar transactions across these 25 states, the law currently requires you to file an application before each of the state advance ruling authority. And we have seen in the recent past, there have been some conflicting judgments also, or the rulings I would call. And for the same assessee, an application has been filed before 2 different advance ruling authorities, and there have been conflicting rulings. This matter has been brought to the notice of the Revenue Secretary, and they are going to clarify on this. Especially we have seen this conflicting in case of solar projects, questions that have been raised, and they have, to some extent, they have clarified in the recent GST Council meeting. Another myth surrounded to it is, there is a fear of audit. Given that application is a suo motu which you can make before the advance ruling authorities, whatever could be the outcome, it could lead or trigger to an audit by the department. And that's a fear some of the clients have expressed when we are interacting, was should we actually make an application? So some of them express saying, let's hold on, till the law gets clarified, because there is a possibility of audit being picked up. That may not be true in all cases. It's actually a facility that has been provided under the law to make an application and get it clarified. So you'll be certain about the question that you are asking. While all of you would know it is binding on the applicant, the facts of the case and the authority involved. While you could refer to those advance rulings, the non-connected applicants can refer to that, but it's not binding to any other person. Unless there is a High Court judgment or a Supreme Court judgment with which the assessors can rely. However, so accordingly, the rulings are binding only to the applicant and to the facts of the case and to the officer till the time the law doesn't change. So which leads to a situation where, in case the advance rulings were to be favorable, then it's going to be good for you and the officer has to bind by it. In case they are adverse, then you have to, in any case, have no choice but to follow that ruling. So it's a more of a business evaluation, and the question in hand whether you would like to make an application before the authority to get a clarification, or is it more of an interpretation issue? Is there a way where you could take a position with respect to the issue that you have in hand and accordingly try to see what is the best alternative with respect to the transaction or the business case that we have? As I said, the application has to be made before the state advance ruling authority. So accordingly, the jurisdiction of the state advance ruling authority is very limited to the operations of that state. So in case you were to get an answer to similar questions with respect to the operations being carried out in other states, you have to file an application. So there is a proposal to bring in a national advance ruling authority. They would come out with the conditions and the requirements around it, where in case any assessee is operating into multiple states, subject to the conditions prescribed, you may have to file an application before the National Advance Ruling Authority. So we are yet to see how it's going to come out. While this myth exists, we have also seen under the VAT legislation, given that it was a state-specific or state jurisdiction of the authorities, we have seen on a similar facts pattern, we have seen conflicting judgments. We have had cases where say Karnataka High Court had a view, we had a conflicting view in a different state. So it's not new for us to see conflicting views. While the GST law provides a single comprehensive law, given the jurisdiction is limited to the state, we are anyways have seen these kind of conflicting views. It's not nothing new, but given that it's going to impact an assessee operating in multiple states, there is a proposal to bring in a national authority where you could have a commonality in case of any question that comes up for other states. Having said this, I'll run through some of the key advance rulings that I've picked up. As I said, there are almost 400 plus and counting advance rulings. Some of them have been really good decisions, I would call. The way it has been analyzed, the provisions, it actually provided an opportunity to look into the provision, and why it has been put in place. While we will have our own analysis of the provision or interpretation, these advance rulings have actually gave an opportunity to look into the way the department or revenue is looking at the provisions of the law. And some of them have been really good, and some of them, as I said, there is a perception that some are pro revenue or pro department. And this is first of the case. So most of you are aware of this. This is a case where a hospital is operating in 6 states, having 10 hospitals, and their corporate office or head office is located in Bangalore. So the issue that came up, and you would know under the law, it has been said that if you have taken a registration in multiple states, each of the registration are considered to be a distinct entities for the GST purpose. So in which case, if you are providing any service from one location, one registered location to another registered location, they are treated to be distinct entities, and hence there will be a levy on that. So in this case, the corporate office received certain services, common services, which are provided to the other locations. For example, the rent of the building. For example, the consultancy services, the audit services, which are typically covering all the 6 registered locations of the hospital. While you have an ISD mechanism where in case of services you could transfer the proportionate credit, you also have a facility to cross-charge to the other locations. And there is a valuation aspect linked to it. Now in this case, the question that was raised before the advance ruling authority is, should the employee cost, which caters to all these 6 registered locations, should also be added while you are arriving at a valuation when you are doing a cross charge. So for example, I have an accounts team, the management team, which looks after the operations of all the 6 units. Should the employee cost be added as part of the valuation or to arrive at a consideration when you are doing a cross charge? While the common services are anyways clearly identifiable, and you could, for example, renting, consulting services, all those can be clearly identifiable, should the employee cost also be inbuilt into the valuation when you do a cross charge? And the reason why it was raised before the advance ruling authorities, under Schedule 3, there is a specific exclusion which says that any services provided by an employee to an employer is not a supply at all, supply of goods or supply of services. So in which case, then should the services of the employee being provided in the corporate office be included in the valuation, given that there is a specific exclusion? And the main reason for allocating this cost is to arrive at a profit center. As you would know, the business wants to see the P&L for each of these locations to see what is the revenue and expenses of it. So they argued that the employee is an employee of the legal entity and not the employee of a registered location, which is the Bangalore in this case. So I am not an employee of the registered location, but the legal entity covering all the 6 registered locations, and hence I would get covered under the exclusion that's been specifically provided under the Schedule 3. Now, the Advance Ruling Authority, while interpreting the provisions of the valuation, Schedule 3 and the way supply has been defined, it says that what has been excluded is the services of the staff which are being provided at Bangalore. And that's where it gets covered under employer-employee services, and not with respect to the services being provided by that registered location to the other registered location. And hence it held that the employee cost also needs to be included as part of the valuation to arrive at the consideration when you are doing a cross charge to other locations. This matter has been raised before the Appellate Authority of Advance Ruling. So they have filed an application before them challenging the order that's been passed. Again, they have reiterated the submission that the employee is the employee of a legal entity and not of a registered location. There the Advance Ruling made it very clear that it is not being prescribed, while the general law recognizes that it's a employee of a legal entity, but the GST law doesn't specifically carve out an exception. And given that it's the registration is specific to the state, and what gets excluded is only limited to the services being provided in Bangalore and not to the services being provided to the other locations. As I said, this is an advance ruling which is binding on the applicant. We'll have to wait and see how the government is going to look at this ruling. We are going to see some kind of a clarification to say whether it is either included or excluded.
So this is an intra-office transaction, just as a recharge voucher between 2 branches, because they are in 2 different states. So at the end of the day, in financial books, intra-office has to become zero only so far as the financial statements are concerned.
Absolutely.
So the question is, for the IGST that is being paid by the branch or the state which receives the services, they will be making the payment, and they will also be eligible for input tax credit, right?
Right.
So in that case, net,
Yeah.
there is no.
So that was my advanced discussion. So the other way to look at this ruling is, as you would recollect, Rule 28 of the valuation rules, which also provides that if the recipient is a registered person, then any value that you declare, would, so long as the other person is able to take a full input tax credit, then any value that you declare will be the open market value. So the one way to deal with this is like you could charge so long as the recipient is able to get the 100% credit. Even if they were to include the employee cost, given that the recipient is able to get the complete credit, it's more of a working capital issue. There would not be any leakage of any tax in this.
Okay.
However, if the recipient is not taxable or not registered, that's where the issue comes, and that's where we would await a clarification from the government in this regard.
This is an IGST. So anyway, the consuming state's share would come to that particular state as per the agreed percentage. I'm not sure whether it is 60-40 or 40-60, I'm not sure. So, and the similar amount it has to give as an input tax credit to the state that makes the payment also.
Absolutely right.
So net the cash outflow from the central government also will be on the same timelines as that of the assessee.
Absolutely
So
right.
this only adds to the administrative work
Absolutely.
for both the parties.
Absolutely right. You're right.
So what is the end objective sought to be achieved by this?
As I said, Rule 28 is there where if the recipient is able to take the 100% credit, he can look at the option of valuing it, and then, given that he is able to get the complete credit, he can take the credit. So it's more of a working capital issue. Any other questions? We'll go to the next case.
What is the frequency we should raise the bills?
Sorry, frequency of?
Raising the invoices for this monthly, or is there any time limit?
Okay, so it depends on the time of supply. So if you have a contract to say per month or 30 days, by which you would end the services or the services would get completed, then within 30 days from the end of the completion of service, you can raise the invoice.
So like rent, salaries and all will be on monthly basis, we will be making the payment for the corporate office.
Correct.
That has to be distributed to the other.
Yes, depending on the turnover of the other locations, you can do a ISD transfer or a cross charge. The frequency depends on your convenience. As I said, completion of service is assuming, we call it as a monthly or 30 days. Or if you take it quarterly, then you could accordingly raise the invoice within the timeline prescribed, which is 30 days from the end of the completion of the service.
But is it compulsory that cross charge between two states have to happen, or there is no such requirement, right?
See, cross charge is or would come into picture when one location is providing service to the other. As I said, the ISD mechanism is there where you get a common input service or services which are common to all the locations. As I said, the audit fees. You can route it through the ISD mechanism.
So, if the end objective is only to assess the respective profit center or the branch profits and losses,
Absolutely.
so instead of actually routing it through the financial records, you can do it in your Excel only for management information system and management performance evaluation. That way you can avoid these complaints, administrative inconveniences and cash flow also. Because you do it only in MIS, will the GST authorities fine for you?
No, as I said, if there is a supply being rendered from one office to another office, then you will have to raise an invoice for that. Say for example, consulting firm operating in 10 states, right? One state get the contract with the customer, but we take the service of the other office. In which case, the proportionate time that is being spent is billed back. So, if there is a service being provided, yes, we will have to raise an invoice. If it is a common input services that are being received at centrally at the office, head office, then you can transfer it through the ISD mechanism.
Who will decide whether the cross charge is genuine or not? Will the department decide or the assessor decide?
Self-determination. You need to evaluate whether you are providing service or not. There has to be a supply, there has to be a consideration, and in case of related parties, even if there is no consideration, it is deemed to be a supply. So all those aspects need to be looked into. And then the valuation mechanism prescribed, you have to arrive at the consideration for that, and then charge it.
See, multi-product companies like say Madura Coats and all. See, there's a fabrics division in Ambasamudram. There's a garments division previously, not now. Now it has been hived up. When it was a composite company, it used to be Van Heusen Vehicle division was in Bangalore. So for the garments division, they will source, they will buy from other companies also. They will buy from their apparel division also. So there won't be any physical cash settlement between the two divisions. It is only transfer ex Ambasamudram to the fabrics division. That was, I'm talking about a 10-15 years back situation. So suppose that happens today, let us proceed for a moment. I mean, you should.
So if you take goods, if you are centrally procuring goods in one location,
Yes.
you can do a stock transfer depending on what is the quantum.
Yes, correct.
If you are receiving services, which are common services pertaining to other locations, you can opt for a ISD mechanism to transfer the credit proportionately. Say for example, the rental of the corporate building, which caters to the services for the other location. And depending on the turnover, you could do a ISD transfer. The other way to do it is if there is actually a service being rendered. Then you arrive at a valuation, given that it's a distinct entity and the supply being rendered. Then you consider all the costs, the common costs that go into that, arrive at a consideration and charge it, proportionately depending on the turnover.
So in the instant case, for the stock transferred from the fabrics division to the garments division, the garments may be at the same price at which fabrics division may be selling to other end customers. They are supposed to raise a debit note or something to the on
Yeah.
and
So
they are physically settling it.
Right. So there is a valuation rule linked to it. If it is a supply between related parties, or if it is a supply between distinct entities, and if the goods are being supplied as such by the recipient, say I send it from Bangalore to Chennai to my office, and Chennai, ultimately sells it without doing anything, without consuming, without using it. Then there is a valuation which says that you have to arrive at the open market value, and you could arrive at 90% of the price that the recipient ultimately sells it to the customer. That's one valuation. The basic rule is the open market value. What is the open market value with respect to the supply that you are making? If you do not have an open market value, then you go for the similar transactions, a similar product, then you go into cost plus 10% as an alternative. And that you can follow in case you don't have an open market value.
How about the advance if it is paid? Even an advance also it will have an impact, right?
Sorry, advance?
If the units have paid the advances to them instead of every month or anything.
Right.
Lump
Advance with
advance.
respect to goods is not there.
But for services, I mean. Only services, right?
Right.
So if the advance is there in this case,
Right.
then it will be GST also has to be level of that on the advance.
Yes. But you can take the credit only when you fulfill all the four conditions that are prescribed under the input tax credit.
Even advance has an impact on this transaction.
Yeah, true. So this is a case, typically we see it in most of the organization. The organization, and in this case, there is a specific requirement under the Factories Act. If the employees are more than 250, you need to have a facility to provide food to the employees. Where they have a facility to buy food items, have a cook, prepare the food, and supply it to the employees. And that's what we typically see in most of the organization. Here the question is, or the facts is that the company recovered the actual cost incurred for preparing the food. There is no markup on it. So say for example 100 rupees is the cost that is incurred to buy the ingredients, vegetables or ingredients, cook, all other incidental costs, and if the 100 rupees is recovered from the employees, should that be subjected to GST? And the question why they have raised is, given that it's a requirement under the law, there is no supply being happened, it's just a recovery of the actual expenditure. Should there be a GST applicable on that transaction? And that was the question that was posed. And also for the reason that under the service tax regime, there was an exemption that was being prescribed. And more so, given that there was a levy of VAT and service tax, there was an exemption from the service tax point of view. So keeping that as the basis, they made an application before the advance ruling whether it should be subject to GST or not. So, and GST is applicable on almost everything. So long as it is a supply, there is a consideration between unrelated parties, it is subject to tax. Profit motive or profit element is not a criteria to levy GST, and that's what has been held in this case. So long as there is a supply, which is a supply of food in this case, and there is a recovery in the form of a consideration, it should be subjected to tax. The profit motive is not a reason for them not to charge tax, and also a requirement under any specific law to have this facility is also not a basis for them not to levy tax. And that was a limited question. Extending this, given that they're paying this tax, company could evaluate to see whether they could take the credit of that. That is something that they could evaluate. Right. Any questions on this?
finally, what is the conclusion of this?
It is a supply and subjected to GST.
But it's not for furtherance of business.
Sorry?
It's not furtherance of business till it's taxable.
See, furtherance of business is extensive word, it's not been defined.
No,
So anything that is in relation to the business, whether it is incidental, ancillary to the main business, so long as it encompasses the running of the business, that is sufficient for due to levy tax. It could be a one-off transaction, it could be a regular transaction. It may not be linked to your primary revenue or operations of the company. So long as it is in relation to your furtherance of business, running of the business, that these are all the ingredients of running the business, it would be, and if there is a supply and there is a consideration, it should be subject to tax.
How about the valuation and input rate can be claimed by the company?
Yeah, they could evaluate to take the input rate on
Input rate. But how about the valuation? They say they are taking without cost profit margin.
Right.
And then how about the valuation comes into play?
So valuation would not or would come into place if the transaction is between related parties. Given that employees of the company are unrelated, so whatever they recover would become a consideration.
No, that's right. In this case.
In this case, the same value, whatever has been recovered at cost, that would be the basis for them to levy GST.
But there will be no invoices at all.
Sorry.
The company will not raise any invoice for that, recovering that consideration from the employee.
Right.
No invoices, how this will be like he is providing, giving food to 400 and 250 people in one day, and for the month also he is not raising any invoice for that. This is a purely staff welfare nature of activity. Is it or not?
True.
Then what is the motive we have to bring this behind?
So as I said, GST is, or the levy under the GST is quite wide. Anything, any transaction that you carry out, unless it has been specifically excluded or exempted, would get covered under the concept of supply. So anything, a supply for a consideration between unrelated parties, and given that it's a Schedule 2 transaction, 5B Schedule 2, which has been deemed to be held as a service. Supply of food, along with or without any other service, is held to be a service or deemed to be a service under Schedule 2. And hence,
this is the word-to-word bookish language. And what is the intention of the government behind this? To trap such type of transactions. How company can just evade the taxation here? How company is evading the taxation?
I don't think it's safe for him to talk about evading. I can only say that, this is a transaction which encompasses the levy of GST, and hence it is subject to this. As I said, it's an advanced ruling. We are analyzing the advanced ruling.
What is my understanding is, like, if any tax is brought in the picture or new tax levy started, there's certain motive of that.
Yes.
Like we need to carve that those transactions. If these things are happening like only word to word we are going, that it would be like government intention of making law.
Right.
And
So if I have to link it to the erstwhile regime, both state and central governments wanted to levy tax on supply of food, right? So there is a deemed supply of goods, deemed supply of services in case of supply of food. So both states had their own mechanism to arrive at the value of goods in the supply of food and levy tax. Now to avoid such kind of a discomfort, in terms of classifying, they have brought in under the law to say that this is a deemed service. And that specifically, if you want, I can read out the wording that are used: supply by way of or as part of any service in any manner whatsoever of goods, being food or any other article for human consumption, has been deemed to be a service. So when it is deemed to be a service, and then in this case it is a supply of food by the company to the employee, and there is a consideration, there is a clear-cut case of being subjected to GST. Right, so we'll have to look into the reasons why they are giving free. One argument could be that it is a supply to an unrelated party and there is no consideration, that could be argued, but we'll have to look into the reasons why it is being given as free, why there is no recovery, or is it there a different form of recovery from the employees. Otherwise, An argument could be made that there is no consideration linked to it, and hence it should not be subjected to GST. Because one of the major ingredient for levy, there should be a consideration for it.
No, but answer according to circular issued by the CBIC that wherever common purpose is given, all the employees need not be the employee relationship comes. So that will not be subject to tax.
No, so what is excluded or not covered under GST is the services by an employee to the employer, and that is covered under Schedule 3. What is not covered is the services or supply by employer to employee. So in this case, it is a supply from employer to employee, and which is definitely not covered under the exclusion. And hence it is taxable.
Under the gift class, that's 50,000 is there, no? In that,
50,000.
whatever facility is given to all the employees, it will be perquisite. So that, like for example, this food facility given to all the people, then circular in this connection. So in that way, probably it should not be covered.
Right, we'll have to look at to see whether it would fulfill those requirements of that gift or any other form. If that be the case, then we could take the benefit. But that, to my mind, if I recollect, it would not get covered under that, this specific case. Say for example, you have completed 5 years in an organization, you get a voucher, say 50,000 voucher, 1 lakh voucher. Those things would definitely be covered under that. You may not have this kind of situation getting covered under that.
Even in absence of consideration, because employer and employer deemed to be related persons, that still attract Schedule 1 and be subjected to tax even in this case. That's one thing. Second thing, even in the other state, if it's given free, can it be considered as it's a consideration for the employment services, because all the salary component need not be in cash. Something can be in cash, which I can give by way of food without any charge. Still, it can be a consideration for the, or it's a substitute for the salary component.
It's a far-fetched idea, but yeah, we could look at this. As I said, it's employer-employee relations, the valuation would kick in. But as I said, we would look at to see why there is no consideration being charged. Is there a different form of recovery being made, or is there a specific reason why they are not charging? Right?
Sir, the employees, all of them, the 250 or 300 guys, they are not related to each other. Therefore, each is a separate, independent, identical person.
So it has been defined that employer and employee are related.
Yeah, yes.
Yeah.
What I'm saying is, can we treat the relationship between the employer and each of the employees as that of a supplier and an unregistered dealer?
No, when it is being deemed as a related person, you cannot extend this to say they are unrelated.
Forgive me for my lack of understanding. Suppose you sell to unregistered dealers, then there is no liability on GST on either party. I think the exemption was there until...
No, that's under the reverse charge. If you are buying from an unregistered dealer, then there is an exclusion. But if you are selling it, so long as you are a registered person, whether you sell it to a registered person or to an unregistered person, it doesn't matter.
The mode of recovery in this case is actually not defined, right? As in, the recovery forms part of the CTC and not directly recovery of cash from the employee. Will that also be a recovery for this?
See, if it is part of the CTC, then there is a facility to say that it is an employee and you could exclude it. But if there is separate consideration being charged, then it could get hit under that.
So the recovery are basically not defined as
no, it has not been covered in this case, how it is being recovered.
But the applicant recovered the amount from the employees.
Correct.
Only it's very
So they have recovered actually. They have recovered the money from them, either by reducing it from their take-home salaries or in another form. But they actually got a consideration linked to it, and hence the levy.
Still there is a scope of improvement here, because seems so this is simply decided based on the words not the intention.
Right. As I said, advance ruling is an opportunity to raise your question, and you would appreciate the law has been evolving for the last 1.5+ years, right? So unless we get a very clear clarity or a direction from the government, it is left to the interpretation of the bench, before whom we make an application. And as I said, there are divergent views on a similar issue before different advance ruling authorities. So having said that, it actually gives you a direction, how the department is looking at the provision. It also helps us to analyze it, keeping that also, in mind. You're right, to say that, there is a scope for improvement. In fact, all the cases you see, as I said, the first one has gone for an appeal. There's a possibility of going on before the High Court, or with a similar set of facts, there could be another application with a different divergent views. So all possible till the issue is settled. Now these things, we could keep getting and hearing and getting to know about it. So the idea of the advance ruling is to get a perspective of, what are the issues that industry has been facing, what is the challenge under the law, what they could not reduce, and what is the clarity that they've got from the ruling authorities, which also helps us to understand from their point of view. So these are only, I would call it as a more of a reference to say, how it has to be treated.
Because sometimes what happens in the industry when employer runs a canteen, motive of recovery is not purely selling of food in term for consideration. The motive is to recover just to people should not waste the food and they should value it. If they are paying some nominal amount, it will be like they will value it. So
Right.
motive is not to make a consideration of something like this.
I wish the law also interpreted logically, but then, we'll have to get into the facts and what the law has prescribed. I agree to your point, no doubt about it. But yeah, at times logic may not hold good under the law.
But we are the professional chartered accountants. We can put our view and make it like this is the industry.
Absolutely. You can route it through a proper forum, proper consortium of trade. You can represent. The government is actually looking forward to hear. We as a firm also made a lot of representation. There have been resolutions that have come up in the last 1.5 years. The government is actually encouraging to make such applications. And it's actually, they're looking forward to hear the issues so that, they could clarify. And as I said, the solar project issue, the solar power project issue, the council, the moment the decisions were adverse or contrary, it brought to the notice of the council, and the council came up with a solution to it. While it's being deliberated, how it has to be implemented, they gave a perspective how it has to be looked into. So you could see that unfolding, as we progress. Probably a few years from now, it's going to be very clear on most of the issues. We may have limited applications before advance ruling is slowly going down.
So many organizations may not be like through a salary deduction. There will be a canteen inside the campus where food items are made available only to employees, not to outsiders. And the price that is being charged will be far lower than the market price. So here the GST will be charged only on the amount that the employee pays at the counter, right?
Right.
For example, what idli could be 20 rupees outside, they may be charging at 5 rupees.
Absolutely.
So GST will be collected only at 5.
Only,
right?
yeah.
Suppose the organization provides breakfast, lunch and refreshments and also pick up drop facilities to its employees purely free. There is no recovery from your salary. It is not part of your CTC. These are all just employee motivation factors, parameters to encourage the employees to keep himself up. Not look at other companies kind of. So in that case, how will you tax? How will you value?
See, anything that is given for all employees in general, as I said, the pick and drop, shouldn't get covered as a service supply being rendered. At the same time, whatever rent a cab that they would be getting invoices, that's anyways going to be a cost, except the exclusion has been prescribed in the credit rules. So if they are not charging and if it is given in general to all the employees, then there should not be any.
Hello. Initially you said that this particular advance ruling is binding only on the applicants, right? Right. Now, there may be many organizations who might be, having the similar kind of things, and based on these rulings, do they take any, what kind of statute or what kind of status they should be taking on? What practice they should follow based on these rulings?
Right. So as I said, it acts more of a reference. It's a guide or a way to say, okay, this is how the ruling has been. This is how the department has looked at the transaction. So it is left to their individual discretion to evaluate and see whether the facts actually apply to their case. They match the facts, and accordingly they can take a call. What they need to do. They need not go with the same view what has been prescribed in the advance ruling. As I said, it is not binding on them. At the same time, they can use it as a basis to take a position, and they would definitely have their legal consultants whom they can get a view and then take a position.
So does this rulings has an impact at the end, let's say at the time of an audit? So I follow my practices as I've been following. I'll not go by this particular things. I'll not charge GST on that, and I continue my practice.
Right.
Does this impact, this rulings has an impact at the time of the audit?
Yeah.
Where
So,
the department take this
as I said initially, the rulings, in case they are adverse to the assessee, the department could pick up and could be the basis or the starting point for them to go after the assessees, to look into to see if a similar transaction is being carried out by the other assessees, what actually they are doing. And basis that they would strengthen the case to impose tax. This having said that, the assessees are left at their discretion to evaluate their facts, take their own view, depending on the way they have interpreted and the legal backing that they have, and accordingly take the position with respect
But
to the
then
tax.
these are not judgments, right? This is just.
As I said, it's not a judgment unless we get a High Court or a Supreme Court judgment, and it results into a finality of that issue. They are not binding on it. As I said, they would give you a reference on how the wind is blowing. Just to keep a tab on such kind of judgments, and then you could evaluate whether it is available to your case and then take a call.
Okay, and one more thing. Is there a way where we can give our view on this particular rulings? Is there in this application or in the window? Is there any way where we can, on this particular issue, I want to provide my view on that particular window?
When you say you're referring to an independent
I
person.
don't want to do a fresh application, let's say.
Okay.
But I have my own view on this particular subject what they have given a ruling on.
Right.
So if in my personal capacity, is there a way where I can give my views on this?
No, unless you make an application to the proper authority, giving the facts and routing to the proper channel, by filing an application, asking the question, putting the learned facts and the reasoning behind what you have thought around the particular issue linking to the law, there is no way where you could actually give your view to the advance ruling authority.
So it's
While you could take your own position and tax position with respect to that, and given that it's a self-assessment, you can implement that to your transactions. That will be picked up during the audit, and you can either substantiate or the department can.
No, like you mentioned, government is inviting lots of thoughts and views from the public at large in terms of this kind of thing. So as a general public, right, as a general person who is going through this, and I have my own views on this.
Right.
Is there a way, any mechanism without going through the whole process of application?
No, you can do a representation through the proper forum. That's one option. You can write to the Revenue Secretary, to say this is what you would believe, and write to the appropriate or your jurisdiction commissioner who can pass it on to the appropriate forum. That's one way you can do it. Otherwise, to my mind, I don't think there's any other, unless you route it to a proper trade or a representative body where you can represent and then file an application before that.
So this is applicant specific guidance, right? It is not.
Yeah, it's applicant specific, fact specific, and the officer who is involved into this. Till the time the facts or the law change, it would be binding on that.
So even in Kerala, whatever we are seeing, another assessee, even though he may think that the facts are similar, the department may not be favorably inclined to use this judgment in the other guy's assessee's case, right?
Yeah, possible.
So
But given that it's a pro revenue, they would always want to use this as one of the reasons for them to go after similar assessees.
So if it is pro assessee, they may expect you to again apply and get a specific ruling in your favor.
Yeah.
So you cannot quote this even in your application, or you can do that?
You can refer to that, on similar facts, it was held and so and so. It's similar to the appeal process, what you make before the High Court tribunal, where you could refer all your judgment basis which you have taken a view. You can file, represent, you can, but maybe going forward, we can see a lot of, rulings coming up on a similar issue. But till now, it's more of unique or one-off types. So this is an advance ruling from the Maharashtra authorities. This is a typical case. In this case, an NBFC, non-banking financial corporation, is into lending of loans, vehicle loans, personal loans, and you would know that they would compute EMIs, equated monthly installments, depending on the tenure of the repayment. And EMI would typically have the principal component and the interest component. And as per the loan agreements that you enter with the assessees, there will be a clause to specifically mention in case any of your check bounces on a particular date, or if you don't repay within the timeline that has been prescribed, there are charges that would be levied. Now, the question that came before advance ruling authorities, in a case where the customer has not paid the installment on time, as per the agreement, it clearly mentions that there is a penal interest or penal charges that would be recovered till the time it has been paid. And it has to be prescribed as a percentage of the amount that has been defaulted. Say for example, EMI is on say 1st of every month and he has defaulted paying that, and if you ultimately pay on 10, for the 10 days delay, they will also recover a penal charges or a penal interest. The question that was there before them is, if you look at section 15, which talks about valuation, it clearly says that interest or late fee or penalty for delayed payment of any consideration for any supply should be part of the valuation. At the same time, there is an exemption notification that's been prescribed where it said that any interest component, when you're lending loans, deposits, is actually exempt from the levy of GST. Now the basic interest, which is part of the EMI, the principal and interest, would by default get covered. The issue is whether the additional charges which are levied for not paying the EMIs on time, in our example the 10 days interest, whether that would also get covered as part of the interest which has been given an exemption under the GST law, or should that be treated as an independent supply, again as a consideration and subjected to GST. The appellant contention was that this has to be treated as an interest. It's a time value of money. What you are recovering is something that you have not paid on time. I have computed my interest only up to 1st in our example, and hence there is an interest component. But having not paid till 1st, I have extended this interest component till 10th, which I have recovered it separately, not as part of the EMI. And hence his argument is that this extends the character of an interest and hence should be specifically excluded from the levy of GST. And under the law there are variants of this to say there are liquidated damages under the contract. In case of any default in the performance of the contract, there is a specific penalty and liquidated damages that are levied. The law also says that obligation to refrain to act or tolerate an act is a deemed supply. The question that came up is it actually an interest? Is it actually a liquidated damages? Or is it actually an obligation to tolerate an act? Because you are tolerating an act of not getting the money on 1st, and hence you are getting a consideration by 10, which is deemed to be a supply under Schedule 2. So is that what you're trying to cover? Ultimately, the authorities always look or go by the documents that are in place. So they went through the loan agreements that are in place. So the loan agreement clearly mentioned that in case you default on payment of a particular EMI on a particular day, there will be penal charges or delayed charges, a penalty that would be levied at the rate of say 4 or 5% on the EMI. Now, without getting into more details, the authority said, given that you have specifically mentioned it is a penalty, you have not mentioned that there is an additional interest that would be levied for defaulting to pay on time. You yourself have admitted through the agreement that there is a penalty that would be levied by clearly mentioning that it's a penal charges. It is very clear that given that section 15 covers such cases, it has to be treated as a supply.
So previously when service tax regime was there, how it could have been treated, sir? Because suppose at that point in time, if the penal interest also suffered service tax, then all the more reason it should suffer GST now.
Right. True. So the definition of interest is a replica from maybe we can park the questions to the end of the session. If you want to cover the slides, that's what I've been told. Okay, you're right. The interest definition has been picked up from the service tax, where the interest is exempt under the service tax. At the same time, it is exempt under the GST law. So as I said, the deliberations came around whether it's a tolerating an act. For that, there has to be an activity from the supplier end to actually treat it as a tolerating an act. But this is actually recovering by default in case of any default. So there's no activity that is being rendered, and hence it should not get covered under the tolerating an act. Liquidated damages, in this judgment, they have strongly contended that alternate views that given that it is liquidated damages under the service tax regime was not taxable, and same thing has been extended under the GST, and they said that it should not be leviable to GST. While there is an advance ruling separately on liquidated damages by Advance Ruling Authority in Maharashtra, which actually held to be liable, but in this case they have not deliberated into that. They have hold on to the fact that the agreement clearly captured it's a penalty or penal interest. They have not deliberated whether it's a tolerating an act, liquidation of so which actually gives us a thought to see what are the agreements, how the agreements have been captured. If it is clearly a penal charges or additional charges that have been levied without clearly mentioning that it's an interest. Because from a assessee point of view, if you think, and most of the NBFCs, they actually borrow to lend. So if they default in paying the installment, which typically they recover from the customer and repay it back, if they are not paid on time, they would be charged additional interest. So it's actually a time value of money which they are recovering it back from the customer. And that's one of the arguments to say that they should take the character of an interest. It's not a specific penal charge that I am levying. While I would have coined, the substance over form should be looked into to see that it is actually an interest that I am recovering because I am paying the interest for not paying it on time. But in this case, they held that it is a penalty, clearly getting covered under section 15 and should be subject. There is a alternate ruling that has come up recently, the Madhya Pradesh Purva Kshetra Vidyut Vitaran Company. Slightly a different footing, but there it was more of electricity. Electricity, as all of us know, is not subject to GST. There, if you don't pay electricity charges on time, there is a surcharge that is collected. So while interpreting or analyzing the facts of that case, the advance ruling has held that given the main supply itself is not taxable or it is exempt under the GST, any surcharge that you recover clearly linking it to the main supply, that should also be not be taxable. So one way we have this ruling, Bajaj, which says that it should be taxable and it's separate, it's not considered as an interest. At the same time, we have another ruling just come out recently which said that given the main supply is itself not taxable, the surcharge which is in the form of a penalty interest should also not get taxable. As I said, it is evolving, so we'll have to see what's the final view of the government on this.
And one small question. If a student is going to appear in the exam, what he will write in this situation? Same question comes in there.
He can write both views. As per this ruling, this has been held as so. As per this ruling, this has been held as so. However, according to my view, given the facts of the case, I believe it should be this. If you always have your own view, anyways, it's not binding on you. You can have your own opinion. In fact, he has covered all the aspects. The evaluator will be pleased to see such kind of a response, saying that okay, he's given a holistic approach, holistic answer. There's no right or wrong in any legal tax position that we take. It's all about interpretation. If you have given both aspects to it, and finally you reduce to say this is my view, and courts have also held when it is a question of interpretation of law, extended limitation should not be applicable. It should not be used. So given that, I think the valuer will be pleased to see such kind of views coming and finally giving his own view.
If it is the fourth view, then the student is lost.
What else can be the fourth view?
Two AIRs,
Right?
so with each other.
One says yes, one says the other says no. So
You said it.
there is no other third alternative. The third opinion would be either yes or no. There can't be fourth. So this is a Rajasthan advance ruling. So the applicant is a liaison office of a overseas entity which was set up only to ensure the quality control of the goods which are ultimately supplied by the parent or overseas entity to the customers in India. So its basic activity is to just ensure that the quality control of the goods. It doesn't have any powers to enter into contracts, do any trading. So under the RBI license or guidance permission, they have set up a liaison office in India. So it's actually barred from doing any activity in India. However, whatever cost that they incur, rental, security, telephone, all those primary expenses for running of the liaison office, they would get it reimbursed from the parent company or the overseas head office. Now the question is it a supply? Is there a consideration? Is it subjected to GST? So the question was placed before them, whether it's a liaison office, it is not a subsidiary, it is not a branch, and all the three are very different. A liaison office doesn't have any powers except to carry out the instructions that are given by the head office, and has a limited purpose of its existence in India. Considering that, so without getting into whether it is a supplier, is a consideration, they have looked into that. They said that liaison office is an extended arm of the head office, and given that it's actually providing services to itself. It's not something two distinct entities or related parties or anything. It is more of an extended arm. It is providing services to itself. While the reimbursement of expenses, there is no activity that is being provided, and hence you cannot call it as an activity for a consideration. And hence there is no supply being rendered from the state to get registered under the GST law. So while once they concluded that it is more of a one single entity, the other answers, the questions fell in place to say that there is no activity, there is no consideration, there is no requirement for a registration. It was just a smooth view for them. This could be one of the tax planning measures anyone could look at. saying that if there is a distinction between a branch and a subsidiary and a liaison office. Maybe countries coming into India could look at this option to say, okay, there's no specific. Of course, they will have to evaluate the other tax laws and other FEMA regulations. But from an entire tax point of view, given that there is no implication, they could look at this option.
So suppose there is a financial transaction in India. You're going to do a finance close with multilateral financial institutions like IFC or AG, EBRD kind of institutions. And they will definitely...
Sorry, what do you mean by financial transaction?
Finance loan syndication. Like you're taking a project finance from these multilateral financial institutions.
Okay.
And loan documentation happens. See, from your side, you will engage Indian lawyers and chartered accountants. But ADB or IFC, EBRD, they will want Clifford Chance or King and Spalding, who are international lawyers, to be their advisors. But the agreement would be that the bill has to be footed by us only, even though they may take any other consultants. So it is like they will send you a bill from their overseas location, and the Indian borrower has to settle the bill. So they will say whatever is the VAT or GST, which is a local commercial tax, we will not suffer that. Our bill has to be settled in total. That will be the requirement for the overseas advisors. So the Indian government will say the transaction has to suffer the GST. So how will it work like that? Suppose you choose to pay the GST or whatever it is on that. Will there be a GST on the GST you have suffered, or it is not suffering GST only because of this? Like in a license office, there is a reimbursement. Here there is no reimbursement. They are providing you services, you are paying for them. It is actually a receipt of services only.
Right.
So how does it happen, sir?
Right. So there is a concept called reverse charge. It was there under the service tax. It is there in the GST. If the service or supply is being provided from outside India to a recipient in India, then under the reverse charge mechanism, the recipient has to discharge the tax. So in your case, it's a service being supplied from, again, you need to look at the place of supply, all those things. But given the understanding that it is a supply from an overseas person to a registered entity in India, and if it is a taxable supply, then the recipient will have to discharge the tax. Now you said they would raise a, say, assuming they would agree for, say, $100. And any taxes applicable on $100 is on the recipient. And you would know that supply is on a gross consideration. Whatever consideration with respect to the supply that you are making, you will have to discharge tax. Now you can structure your agreement in such a way, or that gives you an opportunity to say that if $100 is something that I have to pay back, and there is a GST implication on it, then you have to word your agreement in such a way that the GST is also recovered out of that, and then discharged to them. You may say, so for example, the consideration itself is a 110. I'll pay 100 back. I discharge GST of 110 to the government here. That's how it has to be structured. If they're making it very clear, again you have to look at the income tax because there is a TDS implication on that. So what is the value that you would consider for that?
So you are,
and how you are accounting that in the books of accounts also become relevant. Whether it's your revenue or expenditure is 110 or only 100. So all those matters you need to look at to see what is the implication of it.
yes, in your case, suppose the grossed up amount is sent by them through the agreement to you as an invoice. Like 100 instead of 100, say 110 or 118, whatever it is. And you discharge that by paying 100 to them and 18 to the department. Now the question is whether 18 is a pass-through or an expenditure. That question arises. So, if it is
whatever tax that you pay under reverse charge, if it is being used for your business purpose, then you are eligible to take the credit of it, unless it is a restricted item. In this case, if there is a supply of service, I don't think there is any restriction as such, so you could take the credit. So it's more of a working capital you pay and then take the credit of it. And again, if you are using it for your exempt supply, taxable supply, then you have to proportionately take the credit. So all those workings has to be done.
So lawyer services for financial transactions, is it a service which is subject to GST, or how is it, sir?
We'll have to look into what is the nature of service being rendered. Yeah, prima facie it is taxable. So this is a case before Maharashtra authorities, Advance Ruling authorities, and this kind of situations we have seen in majorly in cement industries. And we had this issue under the VAT extensively. I followed this when VAT regime was there. So any discounts that are offered, post-sale discounts that are offered, whether that is available as a deduction or not. We had this issue going up to High Court level under the VAT regime. And Karnataka VAT clearly said that so long as it is reflected in the invoice, you would allow to get a reduction. Now under the GST, keeping that as an experience, they brought in specific clauses under the section 15 to say that so long as the agreement clearly prescribes that this is a discount that you are going to get post-sale, you are allowed as a reduction. So which means that even after the sale you give a discount, you get a deduction of it. In this case, the question was, and typically to this industry, cement industry, you would say, for example, you sell a bag at say 250 rupees, and depending on the market fluctuation, demand, supply, it can go down or go up. Say assuming it goes down to say 230 rupees a bag, and ultimately the dealers have to subsequently sell it. Now the differential of 20 rupees has been agreed to be given as a discount or a reimbursement in the form of a discount. Now the agreement typically covered, depending on the price fluctuations, you will be allowed as a discount to the extent as may be arrived at appropriate time. That's how the agreement worded. Now the question that came up before the Advance authority, is that sufficient enough for you to take a deduction that has been prescribed under section 15? Section 15 says you take a deduction so long as it is being covered under the agreement. Now agreement clearly captures you will be given a discount depending on the value that you have sold it, and the differential will be given as a price discount. Is that sufficient enough to take a reduction? Now the ruling, they interpreted in such a way that mere mention of a discount in the agreement is not sufficient. It could lead to an ambiguity to say that you can give a discount from 0% to 100%, which is not the intention of the law. The intention of the law is to know what is the value and the quantum of discount that you are giving. While they have allowed the other discount like the cash discount or a volume discount, but in this case this is a price discount, and which is very typical to certain industries, for example cement. They said unless it has been prescribed, it is not allowed as a deduction. While they have strictly followed the law and interpreted to say that there has to be quantum that has to be mentioned. But what we hear from the clients is in the cement industry or similar industries, it is very difficult for them to have a quantum or a value in the agreement as a discount, which they could take it as it's a practical issue. Because it could, one bag could go at 230 rupees, other could go at 235, it could go at 220, depending on the market fluctuation. So they cannot actually arrive at a price at which has been sold and to arrive at the differential. But this ruling clearly went by the law to say that so long as you identify a specific quantum, otherwise it leads to ambiguity to give up to 100% discount. That is not the intention of the law. You cannot get a deduction of it. Even though you may have it as part of the agreement to allow a discount or give a discount to the trade. So which gives us a thought process, okay, this is how it's being interpreted. So tomorrow when we are entering into an agreement, probably this would give us a base to say, okay, let's make it very specific to avoid any confrontation from the government. While as I said, this is very industry specific, we will have to see how the government is going to come out to clarify specific to these industry issues. But it also gives us an opportunity to say, okay, let's be very clear in what discounts that we are going to cover under the agreement. I'll run slightly fast given the time. So this is a typical case that we have seen under the VAT regime also. And the latest one that I have captured below is the Kerala larger bench decision, which is more from a VAT point of view. While rendering the service, if any goods gets consumed with respect to an inpatient, whether you can deduce, carve out, dissect the agreement to arrive at a value or identify the goods and arrive at a value to levy tax. That was the question. And we have a plethora of judgments to say, while Article 36629 here identifies the goods component in a works contract or indivisible contract, but given that in this case, these are all indivisible service contracts. And in inpatients, so in this ruling, they went on to elaborate to say that unless the doctor prescribes a particular medicine, the patient would not be given goods. Whereas, and the patient is bound to take those medicines from the pharmacy that you would have. Whereas in case of an outpatient, he is at liberty to go to either the same pharmacy or to go to any other pharmacy to buy the products. So in this case, whether the goods that are being used by the patients, which are sold by the pharmacy, should be construed to be a goods or should be construed to be a service. And they said that this is an indivisible service contract and it has to be, so goods are only an ancillary activity linked to the larger scope of service, it should be treated as a service. And given that hospital services are exempt and it's been held to be a service, even the goods that get supplied as part of the service are not taxable. And that was the main reason of contention. Whether it should be dissected to arrive at a value to levy tax on goods, or it should be treated as a composite supply or rendering the principal supply of service. And given the exemption that has been covered for clinical establishments, whether the exemption can be extended to goods, they said yes, it's a composite supply where the principal supply is the service and the exemption will be equally applicable to the goods, which is in line with many of the judgments that have come up recently under the VAT regime also. Many of you may be aware of this situation who are in manufacturing industry. This was a typical issue that existed for quite some time. This is a case where you got a contract to manufacture certain components, and to manufacture certain components, you need certain tools to be manufactured to manufacture those components. So the applicant got a contract for the manufacture of tools as well as manufacture of components. And for the manufacture of tools and for the supply of, manufacture and then try to transfer to those tools, he raises an invoice and then charges GST. Now to manufacture those components, he uses those tools in-house and then manufactures these components. So when he is charging a consideration for the components that are manufactured, the question that came up before him was whether the proportionate cost of the tools that are used in the manufacture of the components, amortized cost, what they would call, should be included as part of the consideration when you charge it to your customer. Now this is the issue that while he agrees that it has to be included, many of his customers did not agree to this, and there was a pushback from his customers to say that they would not pay if they were to include the tools, and that's where he had to use this as a basis to go to the customers and say whether it is actually applicable or not. So Advance Ruling authorities clearly mentioned that yes, without these tools you cannot manufacture those components. If you were to get these components manufactured by any other third party who had these tools, he would have anyways included the cost of those tools to manufacture these components. And hence the valuation of the components that are being supplied to the person, to the customer, should have the amortized cost linked to the components being manufactured while raising an invoice and to arrive at a consideration.
Excuse me. If he is supplying to multiple parties with the same tools, how is that going to amortize across those different customers?
Typically, you would, given that it's given a free of cost by your customer, you would typically use those tools only to manufacture components for him. Unless you buy the tools from the customer or you manufacture on your own, that can be used to supply to multiple customers. But typically what we have seen is cases where you got a tool from a particular customer, you would use the tool only to manufacture the components for that customer. So if you are having tools which you are supplying to multiple customers, independent customers, then obviously you will amortize the costs and include it in the cost consideration.
And what happens if at the end of the contract, if it's a single contract, and at the end of the contract, does that tools, when he returns it back to the customer from whom he has received, which he has already charged in the bills which he would have given, how does that treatment happen?
So you are placing the tools at the premises of your, say, you can call him, say, assuming job worker. You are placing the tools in the job worker's premises, and once the activity of manufacturing is over, you are making a supply, or you're moving the goods otherwise than as a supply. You are returning the goods back. So you could use a delivery challan and send the goods back along with the easy tool.
So that tools will go as a free again.
Yeah, there is no consideration. It's your tool, his tool. You are sending it back to him. It is not a movement. It's a movement other than as a supply. So delivery challan with a labels would be sufficient.
So how does the customer will account it as?
Customer would have accounted when the initial invoice that was raised for the by the job worker,
which was free of cost, as you mentioned, right?
No, so
free of cost.
The free of cost is when he is using that for the manufacture of the components. But when he manufacture the tools, he has raised the initial invoice for the tools, and he would account it as a purchase, and he would have capitalized it in the books of accounts. Now the physical location of the tools are at the job worker's premises. And once the activity of manufacture by the job worker is over, he would send the goods back. So from a financial point of view, the goods are his goods and they are already being capitalized. Only the physical inventory is moving back to his premises.
No, tax point.
As I said, it's not a movement, or it's a movement other than as a supply. So you send the goods back from job worker to the principal through a delivery challan. So in this advance ruling, so it's a case where, assuming I have only, so I take the example, I am in Bangalore. I have got a order from a customer who is based out in, say, Kolkata. I have a facility to import the goods into Bangalore, clear the goods, and then supply it to my customer in Kolkata. It would take a lot of time, and there's a transportation cost. Now, can I tweak this transaction to say, okay, I'll ask my supplier to bill it to me in Bangalore and let him ship directly to the nearest post of import, which is Kolkata. And once the goods get cleared from Kolkata port, it can be shipped directly to the customer in Kolkata. I would avoid the time as well as the cost. Then the question is the transaction doable? Is there a requirement for me to take a registration in Kolkata? Can I do, if it is doable, can I do an IGST invoice on the customer who is based out in Kolkata from Bangalore? So these are the questions that have been placed. The reason for that is we have place of supply of services, or I would say location of supplier of services. Location of supplier of goods is not specifically defined, but it is the physical location under the authority of the seller at the point of transaction. Now, by applying this, the goods are physically imported in Kolkata, and you are making a sale from Kolkata to the customer in Kolkata. Now, is it a transaction in Kolkata or is it a transaction in Bangalore? The Advance Ruling Authority says, given that it's an import, you can import in any port of import in India. And the location of recipient in case of an import is the location, the place of supply of goods in case of import is the location of the recipient. And the location of the recipient is in Bangalore and not in Kolkata. He doesn't have any establishment, he doesn't run any office there, he doesn't have any operations to carry out. For him, in case of an import, given the location of the importer is in Bangalore, it is an import into India. It can be imported through any of the ports in India and it can be supplied directly. Now the next leg of transaction is the supply from, given it's a buy and the sell, so the buy is an import into Bangalore. Now given that the buy is in Karnataka or Bangalore, can the sell happen from here as an IGST invoice? Our ruling authority said yes. It's an IGST transaction, given that you have the section 10(1)B, it's deemed to have been received while the goods are moving directly to the customer. So it's an IGST transaction where the goods are cleared from Kolkata port and dispatched directly to the customer, which actually is an opportunity to think, where a lot of overseas companies coming and setting up, instead of doing a multiple, and given that it's a state-specific registration, we could use this as a basis to say, okay, why don't you have only one, and then you could do this transaction this way. You can already think on those lines. So as I said, these rulings are a flavor, what the transaction can be done, and which you could use it as a reference guide to see how we can implement it. While it may not be binding on us, but we can definitely take this as a reference.
So what is the standing if he buys instead of importing, he buys the items from Calcutta and give it to Calcutta customer? So that will be a CGST transaction or IGST?
So when you say buys it to Kolkata?
Yeah, and he supplies to the customers in the Calcutta itself.
So you have a bill to ship to consulate. So long as the bill is raised to the bill to party and shipped to, as I said, section 1B clearly says it is deemed to have been received. Even if the goods are moved locally, in a typical transaction, but if the first recipient or the first bill to party is in a different state, you will have to look at what is the place of supply in that case. Place of supply in that case is the location of recipient, which is in another state, so you charge IGST. Then the next leg is, then the supplier will evaluate whether it is a IGST or CGST. Again, in this case, given that supplier is located in a different state, two different states are being charged an IGST. So each leg of the transaction need to be evaluated to see whether it is a IGST or CGST or GST, even if the goods have moved locally or interstate. So each transaction has to be looked into. While under the VAT, we always followed the goods, how the goods move. With slight deviation from that historical concept, we'll go by the location of supplier, place of supply, and deemed recipient, all those concepts. So in this case, I said you need not take a registration, you don't have anything in Kolkata, you can do a transaction where you could directly import at any port in India and ship it directly to the customer.
If mobile is required in between catches a consignment.
Sorry?
If mobile is required, GST catches the consignment in between from Kolkata to your supplied location. So what are the transaction on what basis that can be substantiated? This is the purely import. And IGST invoice, what should be the documents are there?
Right. So when you are importing the goods, you would typically know where the goods should ultimately be imported. So you can get an invoice to say it is a bill to Bangalore, shipped to Kolkata. And when you are clearing the goods, you would have the bill of entry, the airway bills and other supporting documents. You clearly mention that it is a purchaser is in Bangalore, but I am clearing it to a customer which is clearly routed through the documents. Again, the question would be of e-way bill, because e-way bill is required required for movement of goods. Then can the recipient raise under the law, all the three parties are allowed to raise a e-way bill, the consignor, consignee and the transporter. So you could decide who would raise the e-way bill, accompany all these documents which clearly reflect it's a bill to ship to transaction, have the e-way bill in place, and move the goods.
So till the point, delivery is not done. That should be considered as an import. And after delivering the goods, at the time.
So in this case, it's a X works. In the sense, the moment it is landed into the custom station, then the property gets transferred to the customer. And hence, the subsequent movement from the port to his location was an independent sale. Again, the contract needs to be looked into whether it is FOR or FOB. And whether you are dissecting the transportation charges or inclusive, exclusive, all those things need to be looked into. Even if it is X works, if the contract says the delivery is to the door delivery, then the law clearly says that you need to consider that if it is a different state delivery, then it will be an GST transaction. So the contractual terms linked to the law that has been prescribed will become relevant to evaluate the applicability of it. One point which I did not stress specifically is that the Advance Ruling Authority do not have a jurisdiction with respect to determine cases on place of supply. While there have been few rulings covering those aspects, that's been clearly kept out of the scope, the ambit. For example, I want to make an application to say whether it is an export or not. And to determine whether it is an export or not, you need to determine what is the place of supply. And the jurisdiction is not there because it's a question between two states. It's because IGST would be applicable. So currently it has been carved out. Maybe when the National Appellate Authority gets constituted, maybe they may bring in. Not sure. Currently, the place of supply determination before the Advance Ruling Authority is not being provided.
Sir, suppose you have an AMC only for services and not for replacement of spares.
Sorry, can you please order this?
Sir, can I? Sir? Sir, the AMC is only for services and not for materials. Let us proceed for a moment. And the guy doesn't visit you.
Can I cover this? It's related to AMC.
Sure.
Yeah?
I thought you heard.
No, I'm not that, sir. So this is a case of annual maintenance contract. Along with the supply of goods, you also have a contract to provide annual maintenance. The question that came up was, is it a composite supply or is it a mixed supply? That's the question over there. Because the implication of a composite supply and a mixed supply are different. The composite supply says you need to identify which is the principal supply and apply the rate on the ancillary activities as applicable to the principal supply. And the mixed supply clearly says that there has to be a fixed price, and then it's a multiple supplies, and you have to identify the supply which has the highest rate, and you have to apply that to the other supplies in the contract. In this case, whether annual maintenance contract, is it a supply of service or is it a supply of goods? Because the implication would differ depending on the rate. Sub-services anyways 18%, goods depending on what the character or the nature of the goods, you would levy the tax from 5% to 28%. It is held that it is annual maintenance contracts, and we have seen this in the previous regime also. It's a composite supply. It's a composite supply of goods as well as services. Now, given that specifically the GST law asks you to identify what is the principal supply, if you take an example, the first year I may not have any replacement of goods. Say for example, I enter into an AMC say for 1,000 rupees. I may not have an opportunity to replace any goods in the first year. So the service is the principal supply typically, and the goods is incidental and is assuming next year I have almost 90% replacement of spare parts components and a very limited service component. So the question is, do I have to evaluate every year to identify what is the principal supply, whether it is goods or services? You've seen this in the service tax regime also. So AMCs are considered to be a supply of service. And in this case, the principal supply is a supply of service. The goods are only incidental, ancillary to the provision of the principal supply of service. So whether you replace any goods or whether you do not replace any goods, and in case where you are replacing, whether the quantum is high or low, it doesn't matter. It is a supply of service, and hence you have to levy tax accordingly. And they also went on to say these are all naturally bundled, cannot be dissected. These are all naturally bundled, which is one of the requirements for you to treat it as a composite supply. And these are inseparable activities, and the principal supply is the service, and hence you need to treat it as a service.
So maybe out of the it's AMC for 3 years, and it's a continuous supply service. If I raise the invoice, when can other person can evade that credit?
Sorry, can you repeat? So you're saying it's a 3-year contract?
Yes. And I have raised the invoice in one shot.
Okay.
It's a continuous supply service.
Right.
And then when the other person can buyer can evade the credit?
Okay, it's a practical question, I know. So typically AMCs are, the invoice with respect to AMCs are raised upfront. Whether it is insurance contract, whether it is an AMC, you typically have the invoice upfront, and the service of insurance or an AMC is spread across the duration, which is, in our case, it is 3 years. You spread across the 3 years, the consideration that you receive is actually spread across. So the view that was largely taken under service tax is the moment you get an invoice, you have to charge tax and hence the credit also. But in the GST regime, there is a specific condition that there has to be a completion of service. Completion of service, which means you have to receive completion of service. In this case, it is, can you argue that it is completing every month, every day, every year, or at the end of the tenure? Right? And that's the question. If the contract is in such a way that you raise one shot, one invoice covering 3 years, then it's going to be challenging to take it in a piecemeal. You will eventually have to wait till the completion of service. But if there is an opportunity for you to split this invoice, to have it in periodical, at least on those periodical intervals, say for example 3 months, 6 months, 1 year, you could take it depending on those intervals that you have. And once that period is over, you could take it instead of waiting it for the 3 years. I agree, there is a challenge that there is a view that you may have to wait till the end of the 3-year tenure. But if there is any opportunity that you can split.
At the time the invoice, the validity period will go over and I will not be able to evade. So there is a time limit to evade the credit for before filing the annual return or the September monthly returns. So in this case, since it's 3 years, so my customer will not be able to take the credit if he has to wait for 3 years.
So that's why I said you can split it to have this periodical invoice, keeping in the limitation under the law. You can have this and then take it away.
So, telecom AMCs will be taken with the original switch or network equipment vendor. So those guys will not physically visit the country. For example, they will log in from US into a switch and they will do the maintenance. Okay. Will it be an import or is the place of supply in India? How is it?
So we'll have to look into the contract, how it is being structured. Who is the contracting party, who is receiving it, and who is paying the consideration, where is the supply being happening. So all those need to be looked into. But the thumb rule is, if you are receiving any service from overseas or if you are giving the service within India, against the consideration it should be taxed. But as I said, we'll have to look into the contract to see how it is being structured.
It is a telecom company in India, the switch is in India, the vendor is in US, AMC is taken with the US vendor, and once in 3 months he logins into your switch from US, and for 1 day or 2 days he does the maintenance, submits the report and raises the invoice.
So given AMC is a service, if it's an annual maintenance contract, and if it is a service, view that is taken that it is a service, then the supply is happening, the service is being rendered from overseas to the recipient in India, and it's clearly covers under the reverse charge mechanism.
Import of service.
So it is not an import that we can claim.
No, reverse charge amendment is an import of service. It's an import of service under the reverse charge mechanism that the recipient will discharge tax, and he can claim the credit subject to his output service.
Can this be held good for warranty contract also?
Sorry?
Can this be held good for warranty contract also? I mean, the supplier is giving me a warranty also on an additional cost. Where he says if there is any damage in the next 2 years, I'll repair it and give it in. But again, that might happen and that might not happen, but I'm paying it upfront.
Yeah, same thing. Because in warranty, typically you recover upfront whatever you are replacing in a future date. And that's been the cases under the VAT regime also. So, even if it is given free of cost, given that you have already paid the consideration for that, you could, as I said, there is a limitation on the time limit of availing credit. You will have to plan in such a way that you don't hit that limitation and accordingly take the credit.
So, same applies for insurance also? Excuse me?
Yeah, same thing. As I said, insurance also is like we typically pay the insurance premium for a year or depending on the type of contract. So you pay and then the insurance coverage starts and then you again pay once it expires. So while you pay upfront, your coverage is for the entire duration. So then is it that your service is already being provided on the day one, or is it spread across every day, every minute, or at the end of the contract? So the view that was largely taken under service tax is service is provided, but the consideration is, the service is being provided, consideration is received upfront.
And in the case of compulsory maintenance contract, compulsory annual maintenance contract, can this would be considered as a service contract only, not supply? Suppose,
Yeah, how does it, whether it is a compulsory annual maintenance or whether you opt to take an additional maintenance contract, it doesn't matter. The character of the transaction would not change. So long as it is a composite supply of service and goods.
There are some specific vendors, they say if you buy this product from us and regularly you will use some of the material from us only, and we will give the maintenance only, you will have to take maintenance from us only.
Okay, that's more from a contractual binding point of view. It's more a commercial decision that the company has to look at.
And their material cost, if they sell independently in the market, there is a higher taxation. And if they give the normal services, there is a lower taxation.
Okay, so as I said, it's a more of a commercial decision to have the same vendor providing the service. But even having said that, it's a service of maintenance, and you would evaluate what is the taxability of it, and you could take the credit subject to the conditions being prescribed. Fulfillment of that.
Company, being a company, like being a corporate, if there would be any tax liability on them also, for noticing this thing, the vendor is not doing properly. Suppose vendor is not raising invoice, proper invoice.
No, so if you are referring to a vendor who is being given a contract of annual maintenance, which he is providing to you, he needs to evaluate what is the time of supply. When is that he needs to raise an invoice? There are obviously guidelines, and it again boils down to the way the contract has been entered into. If the contract says that I am providing an annual maintenance contract, I will raise an invoice on a periodical basis, monthly, quarterly, half yearly, annually, and that's the time of supply for him to raise an invoice. And once he raises, he will have to obviously plug in GST 1, it comes to you as a GST 2A. And subject to the conditions being prescribed for completed, you can take the credit. So if he is not doing it, then contractually you can check with him, because you would be you will have to pay him, but he would not, because anyways he's providing service, he would definitely look at when to raise an invoice. If he's not raising, then it is good for you till the time he raises.
Not good for us, but not good for the revenue.
True, but again, as I said, if the contract clearly says the service is being rendered and this is the milestone linked to it, if he has not raised the invoice linked to the milestone, then it is a contravention of the rules prescribed.
So my point is, this is a fraud in the your system. Like if there's a leakage of revenue, there's leakage.
True.
Of
So the authorities. So the law also says if you don't raise an invoice within 30 days from the date of completion of service, again completion of service will have to be looked into how the contract has been entered. If there is a completion of service, even if it is milestone, and if he has not raised the invoice within 30 days of time limit that has been prescribed, then the time of supply clearly says that it is deemed that time of supply is when the service has been completed. So even if he has not raised the invoice, his obligation and his liability to discharge tax triggers the moment the service is completed. So he would be at default. So tomorrow the authorities can question, why didn't you raise the invoice? While you are not obligated to question because you have not taken any credit, you don't have any invoice to take the credit. So they may not question you, but they would definitely go after the supplier to say, why didn't you raise an invoice? And there is an interest penalty component linked to it.
So how the revenue knows that the service is completed unless he discloses?
Everything boils down to the agreements, the way it's being structured. You have to clearly spell out what is the service being rendered, when do you raise the invoice. We take our typical consulting invoice. We say we are providing this service, we'll raise the invoice on a monthly basis, quarterly basis, or if it is a one-time assignment, we'll say upon completion of assignment, you have to pay within 30 days. All those contractual terms are there. So they will first pick up the agreements in place, they will look at the returns and the supporting workings linked to it to see what have you done with respect to this transaction, and they'll pick up and they'll say you have evaded the tax, this is the computation, you pay interest and penalty along with the tax. They have devices to identify the leakage. The other next step would be to compare it with the financial statement to see whether you have reported all the revenue subjected to GST. And do a reconciliation, identify the gap, and they will ask us to explain what is the gap.
So revenue will not create problem for recipient, only for the supplier.
They will not create a problem for recipient so long as recipient has not taken the credit.
No credit.
If the recipient has taken the credit, okay, and if they believe that the provider has not paid the tax, then there becomes an issue. We had this issue under the VAT where we took the credit. We always fought saying that there is no provision under the law to go after the supplier whether he has remitted the tax. But to plug that, we got in a specific condition under the GST law to say you have to ensure, or it says that the tax on that supply has been remitted to the credit of the government. Now till the time it has not been gone to the credit of the government, you are not fulfilling one of the 4 conditions, and hence you cannot get the credit. Right? So you will have to use your commercial balance to say how you can get a confirmation from him. There are ways of doing this by getting confirmation, copy of the return, challan, backup workings, all those things can be one of the tools. Or now you report in the GST one, it gets reflected in 2A, that should be sufficient also.
Sir, this import of services that just now we discussed, instead of making a payment through reverse charge mechanism, can we submit the letter of undertaking and then
Letter of undertaking in what sense?
generally for imports, we can import the submitting some letter of undertaking.
No, so letter of undertaking before whom? No, so if it is a service, if it is goods, then obviously the customs authorities. If it is service, typically the authorities will go to your foreign currency expenditure in the books of accounts to see, and they will ask you to give a breakup of it to see what is the services, what are the goods, related party transactions, all those things they will look at. If you have received, if there is a foreign currency payment reflecting in the balance sheet, and if it pertains to a service being received from outside India, if they are taxable supplies, then obviously they will be subjected to GST. You should have a strong reason to say, you know, why GST is not payable, because credit is anyways applicable. And that's one of the recent ruling that has come. Credit on the reverse charge is anyways applicable. That should not be a reason for you not to pay reverse charge liability. That's a recent judgment that has come. And of course, that's on the service tax regime.
So this retroactive taking is specifically only for goods, not for services. This is what I understand, right?
No, if you are talking about LUP, with respect to the exports, you have an option not to pay IGST with respect to your export of goods or services. Again, as a letter of undertaking. Letter of undertaking, you give a declaration, all those things. Subject to that, you do not charge on the face of the invoice when you raise it to the overseas entity. But what we are talking on the reverse charge, where you get the service, where you get the invoice, you only make the payment to the vendor. I think I'll cover the last one. We don't have time. So this is testing services. Okay. This is a question, you know, it's a case where a prototype has been given to the applicant and he works on that, you know, to do some testing, and the final report is given to the overseas entity. The question is it a export or is it not? While it is linked to the place of supply, which is not the jurisdiction of appellate advance ruling authority, they have gone ahead and given this. The section 13 clearly says that in relation to a transaction between a recipient in India and one of the parties being outside India, and if the goods are made available to the assessee to work on it, then the place of supply is the location of such goods. Here the contention is that unless the report is delivered to the overseas entity, unless the report is evaluated to see the feasibility of it, the contract is not concluded, the service is not concluded, and in which case, given the completion happens at the recipient end who is outside India, the location of the recipient who is outside India should be considered, and hence it should qualify as an export. But the ruling authority said no. The moment you complete your activity of testing and prepare a report, the service is concluded. The report could be used or may not be used, they will scrap it. But the activity or the service that you have been hired for is completed the moment you prepare the report, which is typically done on the goods that are located in India, which are made available by the recipient to the provider. And hence there is a specific provision under section 13 and said it is the location of the goods, so it should be subjected to tax within India and not an export. So I'll end this here. Last one I will cover. This is a case of a dealer where he purchases car for demo purpose. The question before him was, so if you see this input credit provisions, the motor cars that you purchase, so long as you use them in the business, it's not allowed as a credit. Of course, there is a recent exception for that. So in this case, the demo car that is being used, he uses it for demo purpose. Now the question is he using it for furtherance of business? Because he is ultimately not selling it, he is just placing it in your showroom, displaying it, whether that would be construed as used in the furtherance of business. So Advance Ruling Authority said this is an important ingredient for running the business. Without demo car, the dealer cannot run the business of selling cars. That's one of the reasons, and hence it is being used for furtherance. And ultimately, after the demo usage is over, so after 1 year, 2 years, 3 years, it is anyways ultimately going to be sold. And there is no limitation under the law to say furtherance of business has to be immediate or at a later stage. So long as it is used for furtherance of business, given that there is no time limit that has been prescribed, the ruling authority said the demo cars, the credit on it, the tax that has been paid is eligible as a credit. Yeah, so demo car is an indispensable tool for promotion of sales. That's the word that they have used. And given that ultimately it's going to be sold, it is considered to be as per the terms of business, and hence credit is eligible. And we had a live case on this, so this helped us to strengthen our argument. More of a limitation society.